Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
It's the first Saturday of a new month. We wrapped up the month of April and we are now in May. So welcome back for another weekly market recap. Quick disclaimer before we go. My voice may result a bit raspy or a bit strange. That's because, it was Labor Day yesterday here. So I went out and stayed out all day, but it was a bit windy. So I might have catched a tiny back cold. It's not a huge deal, but my voice could be impacted. So it's not your audio, it is actually me. Bear with me for the initial stage of the video. It should get better as we go while I warm up, but, initially it might be a bit strange. Now, with that out of the way, let's have a look at what happened throughout the week. Now, there were a few data points coming out. We're going to look at them briefly because, we are back into earnings season. So I think the market is not really focused on macroeconomic data right now, unless you have huge surprises, right? But for the most part, I think the focus is shifted, from the war now to earnings. But, for the sake of it, we got ADP employment change coming in good enough. If you look at this data set right here, now it starts to populate itself, and you might be able to spot a trend. A trend, it looks to be pretty good, although, don't discard the fact that there are other factors in the labor market which would suggest deterioration, and we have been looking at them for months now. But again, up until the point it doesn't crack, you could still call it quote unquote resilient, all right? But this is just one data point. There are a few more that you should you put in the equation to have a bit of a much clearer picture, but this is what we are working on when it comes down to this one, right? Then again, we got GDP, which came in at 2%, slightly below expectations, but a rebound from the previous read. Now, even in here, if you check the description, what you see is that, government spending came back after the shutdown, all right? And we still have investment in equipment and infrastructure due to the AI buildup, I guess. But, we also have, if you look at the net trade, right, situation, we got imports going up faster than exports. And again, I'm still thinking because of the energy situation, it could be a bit of a front run, right? Since, a lot of stuff which you need in America to do business, it's actually bought abroad. If you think prices may go up, what you do, you buy now so that, you replenish your inventory now if you fear that prices could be higher 1-2 months down the road, right? So again, same as last week, it's a little bit of a front run still. We can see that in many different data points. At least, for me, it might be totally wrong, but that would be my read, okay? Then we got personal income, ticked up, not bad, 0.6, although personal spending went up to 0.9. So again, it might be just a tiny difference. It might be a quirk in the data points, but in the very short term, if you spend a tiny bit more than what you earned, where is the difference coming from? Credit card debt or buy now, pay later? Who knows, right? Now, on one side, up until the point the consumers can keep on spending, the economy should stay afloat, right? And again, we've seen it in GDP, which again, at 2%, it's not bad. It's kind of the standard for an economy like the US, right? So for now, no huge surprises there. We got PCE, right? Okay, which, since the fact that now we are looking at March, we start to see a bit of an impact from the war and oil spiking to the upside, right? So now the data, it's starting to pick up a bit of that. 3.5, is that a lot of, I mean, sure, it's an increment. If you look at the core, though, I mean, you may say that the trend is still grinding to the upside, so a little bit of reflation, but not to the same degree that you can notice in the normal, the headline PC, right? Obviously, if you strip out food and energy, obviously the chart will be a bit more, a bit smoother, right? So should you be worried? Well, I don't think so. I mean, if you remember previous videos, we have been talking about a potential, bounds in inflation and inflation expectations or inflationary pressures in general. So, I mean, I wouldn't be surprised, right? Again, I wouldn't be surprised even if we see next headline CPI going up to 3.2, 3.3%. Quite honestly, it's kind of where you would expect it to be. Even 3.5, right? Unless I see it being sustained, right, I wouldn't be overly concerned. Okay. Then moving on, we got Chicago PMI, which it came in contracting territory this time around. So again, I think it was a bit below expectations. Let me check. Well, I mean, beyond expectations alone, but what we can just observe is that it went up, kind of peaked, and now it's rolling over. So a little bit of a decline in activity. Doesn't look to be serious for now, but yet you register that we went up, now we came back down. So it's going to be interesting to see what's going to happen from here, right? Do we keep on declining? Can we get stable around here? Can we rebound, right? But for now, not a lot of interest on my end. Then what? Manufacturing PMI, which, stayed relatively stable at these levels. Finally, is trying to staying above the 50 level. Remember, this is a fusion index, so everything above 50, it's kind of positive. Below 50, it's negative, it's contraction. So 52.7. Now, again, I'm not particularly focused on the fact that this one is positive or negative, but to me, it's more of a barometer in the sense that, okay, if producers are paying a much higher price, are they able to pass it on to consumers later on, right? Up until the point they can, cool. If they cannot, that's bad in my view, right? But that would be consumers rejecting higher prices. Therefore, the producers would have to absorb them, and it doesn't end well when you start to go down that road, right? And then manufacturing employment. Again, as you can see, a little bit of a peak on that. It's scrolling over a tiny bit. Sure, it's just one bar, so you would need a few more data points in here. But, I think even in this one, maybe a few months down the road, we may look back at it saying, see that? It was just temporary, but at the end of the day, it wasn't sustainable. As in, more manufacturing being built up, more jobs being created, the sector being expanded that much. I still think that, quite honestly, the efforts are there, and potentially legislations and interventions on the government side are there. Now we need to see how the economy will respond to it. And again, whatever you think of the current administration, that's the goal. The point is now to see how long before the effects are going to be showed up. And, first and foremost, if they're going to show up. And so this is a story for the mid to long term. It's not something that you can resolve in 6 months or 1 year, all right? Other than that, as for the break-evens, again, still pointing to much more inflation down the road. And you see the red line being above the blue, so 5-year break-evens being above the 10-year. And it looks now that, actually, they are moving up in lockstep. I don't really notice, at least with the naked eye, these delta particularly increasing or decreasing, right? 5-year forward inflation expectation rate going up. I'm just looking at, a yearly chart in here. But again, if you do remember, that was basically the beginning of the year. So you got at a point in here, the war starting and the energy spike being triggered. So initially it went down and then up it went. So, with time going, with time passing by and the, maturing the idea that probably the conflict and the blockade of the Strait of Hormuz, the disruption in the supply chain of energy will last a bit longer than anticipated, expectations need to readjust themselves, right? So again, we'll see. Other than that, trueflation, although is delayed 5 days, but let's take it as it goes. Below 2%. As for the headline CPI, PCE is around 2.5%. So, basically same levels we were last year in October, September, November, all the rest. So again, I don't see it as a huge change for now. But again, the situation there, it's particularly fluid, right? Now, this was interesting. We just had FOMC this week. And obviously, nothing burger. They didn't change rates. Why should have? Why would you do that, right? But now, if you check the odds now, right, still for the next meeting, and again, I know there are 6 weeks ahead of us before that, but it is just kind of funny that now they are contemplating the idea of a cut, which again, it might just be because you think Kevin Walsh will come in and being a dove, maybe not. I don't know about that. I don't know him. I just read a few things here and there. So, it will take me time to readjust from Powell, right, to Walsh, right? So, give me a little bit of time. Although, I gotta say, at least, during the last press conference, Powell went with a very hilarious moment. If you didn't notice, here you have it.
Howard Schneider with Reuters. You mentioned that staying on as the governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can... Touche.
And that was it, right? I mean, that was really funny. Now, credit spreads are still on the, basically on the floor at this point, even if you zoom out, right? We have a look at a much larger time frame. Let's see if I can refresh it. Looks like I cannot, so who cares? But, just for your information, it's still very low, so no problem signal there, right? And that would be it for the economic calendar and the macroeconomic data. So let's just jump into the charts now. As for the chart, let's start out with the DXY. There is really not a lot to say about that. I mean, we have seen the bounce at the end of the day, but it looks like we have been rejected at what was, support first, then broken down with a gap, rejection, back into support. Up we went again into the old support, now confirmed as resistance. So we are trading in this tiny little range for now. So I think at the end of the day, nothing really happened as for the DXY this week. And it's going to be the same basically for all the other currencies, which is why we are not going to spend that much time on them. So, the only one thing would be, okay, so up until the point we are in this range, same as above. It's a range. How do you do that? Well, you buy the lows and sell the highs up until the point it lasts. And when it doesn't, something else is brewing. So I would just wait for it to break one way or the other. Probably it will happen with a fundamental trigger. It may be something coming out of the Middle East. It may be something which happens at a, administration level in the US, or maybe the Fed saying this or that when Walsh actually sets in. So who knows? But for now, I wouldn't read a lot into it. It's just going sideways, right? So not a huge deal for me. And as you can see, the rest, it's doing basically the same. The euro kept on pulling back a bit. And now, for this week, It just went sideways, a bit up, a bit down, but didn't really go anywhere. The only one thing we may register if you look at the euro versus the British pound is that if in this segment right here, right, basically mid-March forward, what you could observe is that the euro was making higher lows while the pound was making lower lows. So there was a relative strength, in the euro compared to the pound. Now you see kind of the opposite. You see it is high, and it is, for now, lower high in here, while instead the pound made the same high and then a higher high. So maybe, are we seeing a little bit of a shift in relative strength? It could be. As for the Japanese yen, we got what? We got a yen intervention, right? And again, it was widely anticipated. We have been starting to hear rumors about it basically 3 weeks ago, 2 weeks ago, something like it. And it looks like at the end of the day, they went for it. Now, look, when you look at the technicals right after something like that hitting the market, take it with a grain of salt. At first glance, it would seem like we kind of reclaimed this level, right? But again, look at what happened in the past. We got situations like that in the past, and at the end of the day, it took a bit of time, but the trend just stayed what the trend was. So I wouldn't hold my breath for it. I don't think it's going to change a lot, especially because, whenever you see something like that, or whenever you hear the BOJ talking like that, the first type of reaction is, wait, they're going to break things because, if they prompt up the yen, they're going to break the carry trade. It's going to be unwound, and that will create a massive shortage of liquidity and a sell-off in other risk-on assets. Look, just stay cool for a minute. I don't think we're there yet. It takes a hell of a lot more than this to break the yen carry trade, right? So for now, although again, you may found people on Twitter and YouTube saying this or that, I don't think this is enough, and I don't think we are even close to actually provoke a yen carry trade event, right? So it's just, take it as it is, right? Yeah, sure. I mean, we were trying to go lower, and of course, notice the timing of that, right? The BOJ usually takes these spots, but it looks like the market is particularly weak to intervene. And why is that? Well, because, they are not traders, maybe, but if they know they can move markets around, they're going to wait for the chart to induce or, to see the vast possible, the biggest amount of people going short or piling in bearish to surprise them, with an intervention like that. So what's happened? Well, basically, all those people being short, especially in this range, they will need to close down the shorts, and, the upward move, which will be fueled even more by those shorts closing, is going to help the BOJ in the intervention, which is why I think they always wait for the market to look particularly weak, even in this case, right? See that? So, again, I don't blame them for it. If you spot a dynamic which could help you in your intervention, why not take advantage of it, right? Canadian dollar, nothing really changed. After this bounce right here, it just kept on going higher and higher toward the highs. It looks like, again, we basically reclaimed these old apex space, kind of like, want to put it in here, more or less, all right? But as you can see, we just got back in the previous dealing range, which was confirmed as an apex first, but then looks like now we are back in it. Same for the Swiss franc. Still, if you draw a trend line in here, you see it's still operating on that premise, so still trying to maintain strong enough. We didn't get the same type of dynamic that we've seen in the dollar Canadian, which would be something like this, basically reclaiming this level, getting back, above it into this range. But I mean, it could happen later on. We'll see. May also be that at the end of the day, we see this one not being able to do the same thing that we have observed in this one. So who knows? They don't have to move necessarily altogether, right? As for the rest, Chinese yuan being kind of stable. We had a tiny, huge run up in here, right? Wait, tiny, huge? That's an oxymoron, right? We had these run up. So it's just normal for price to get stable a little bit, okay? Nothing substantial changed in this one, as you can see. Same as nothing changed in the South African rand. Down move, pullback, same level hit. Rejection once again. Back down we go where? To the last accumulation, which originated this retest. See that? In here. And we went up. Same level rejected. And the bounce is basically in the last pocket, which originated these, last bounce. Then what? Ruble still up. Indian rupee on the other side of the coin, still down. All right. And the Brazilian real still relatively strong. This is really strong, to be quite honest. Right? In relative terms, obviously. The Australian dollar, again, doing fine for now. Don't see any signs of weakness in this one. So again, the currencies, they basically stayed relatively calm this week. Not huge changes. I mean, if ever you have huge changes in just 1 week in currencies, right? Let's have a look at gold instead. Now, gold, it tried, and at the end of the day, it broke this short-term momentum right in here, basically at the beginning of this week, all right? And we pull back in this pocket right in here. It's kind of like a tiny base overall. So, look how fractal it is, right? Now, look at this segment right here, right? And then look at this one. So what you see in here, it's the market going up, right? It goes up, it goes up, it goes up. And then it pulls back into this pocket right here, into this huge range, right? It bounces, a bounce which is quite efficient, all things considered. It's a little bit of a drawback. Then it breaks and it gets back into where? Same area right in here. Now, with the huge liquidations, it came back a bit lower, but then again, you had another bounce. Now, if you think about these base, the initial reaction and the redistribution, you got the same type of short-term base, bounce, redistribution, kind of like this one, right? So now what? Do we test a bit deeper into this fractal right in here and then maybe another tiny bounce? Can we actually hold the area as a whole, right? And trying maybe another push higher. And then the story becomes, okay, where to? Like, if we can bounce from here, do we go, let's say, in here and we work on another lower high? Or can we actually push and try to make new highs now? It's pretty early to tell, I guess. First of all, we need to assess what's going to happen next week. This is it, right? This is the bounce we were looking for. Or do we need to test a bit deeper in it and maybe working on a bounce from here? And then we'll see. Obviously, again, I keep on maintaining the same stance up until the point we can stay above this region right here. In between 4,400, 4,300, I wouldn't be leaning massively bearish. As for now, best case scenario is that we just go a bit sideways in here. Now we'll see, right? Don't have any particular feeling on gold. I can just register that this short-term momentum for this bounce it was basically exhausted and it was faded. So now we need to work out what's going to happen from here. So just give the market a few days and let it showing what he wants to do, right? Other metals, silver was particularly flat over the last, well, basically a month, right? It just went sideways in this range. Not a lot here. Palladium, kind of like silver, maybe a bit weaker if you just look at the structure, right? Same story with platinum in here, right? And of course, relatively speaking, copper, it's the strongest among these four, right? Now, I'm sure there are many others, but these are the ones that we check regularly. So, I think the fundamental drivers are not changed. Of course, how can they change in just 1 week? So, basically a copy paste of what we were discussing last week and apply it back to the charts we're looking at now. Nothing really changed for me, right? Let's have a look instead at Bitcoin. Now, we were looking for two things in Bitcoin in order to assess if this bounce was ended or not. Now, one was the break of this momentum. The other, which at the end of the day, it's usually the most important, was the break of a very important structural point, right? Now, we had the break of momentum, right? But, never really traded below this low, let alone closing below this low. So for now, actually, the week ended up on a bit of strength. So, we have discussed the relevancy of this level, right? So actually, if the rest of the market, broadly speaking, if we stay on this risk-on phase, actually seeing a market drawing back into a previous level of interest, tapping it, and then you see the rejection, which is not that strong, right? And soon after, the market reapproaches the same level. I think that's more bullish than not, right? Because it just means we are slowly grinding and eroding all the liquidity on the sell side that we have in here for now, okay? So, yeah, sure, the momentum kind of faded a bit, is low down a bit, but up until the point we are above, is low right here, can't be bearish, right? Now, sure, you could now also pick this one, right? So if we cannot crack these highs right in here, right now, right, and we are rejected below this low, right, you could apply the same logic we were trying to apply here, right? But, I would guess we need to stay a little bit more on the bullish side up until the point we really see this one being faded. Because, we might have another tiny rejection, but then the market could reaccumulate again, trying to push higher again. So at the end of the day, I think the odds for now, considering the broad market, are still a bit more to the upside short term, and then we'll see. Obviously, sure, you could raise your point of invalidation from here to here, but, I would start the week leaning bullish up until the point we don't really start to break lows, right? Can still go sideways for a little bit. That wouldn't be surprising. So, clear points of invalidation, both for the upside and the downside. Other than that, don't really see anything else on Bitcoin, right? So, let's have a look now at yields, and then we are gonna have a look at the stock market and wrap up the video. So let's check these yields, or, the bonds or whatever. Now, I forgot we do also need to check oil later on, but, anyway, the schedule at this point. So starting out with Treasury futures, they, of course, went down this week, right? A tiny bit of a bounce on Thursday and Friday, kind of, but the week overall was a bearish week. Now, you might say, okay, again, if you look at the other side of the coin for yields, you see them trying to going up, right? Now, this time around as well, there is for now a tiny bit of divergence, whereas the short end of the curve, it's not really making new highs, in the short term yet. The 10-year, neither is not doing that. The long end, it looks like, yeah, it went for a new high. So, a bit of a divergence there. And I know that a lot of people are still on the side of, well, you see that? This is it. If yields will spike to the upside, the government will go bankrupt because they basically wouldn't be able to fund new debt or servicing the current one at a higher level of interest rates. Now, I would say, first and foremost, interest rates at this point, they have been actually higher for longer, right? And you didn't see the government going bust. At the same time, you didn't see people stop buying treasuries. Actually, especially foreign holders of treasuries, they kept on buying at a record pace. But, regardless what could happen in the short term, right? I would assume, right, considering what's going on in the world right now, in geopolitics, in the energy market, it's not surprising for me to see yields trying to take a bit higher. First, you may say, well, because inflation expectations will go up, aka yields should reflect that. Absolutely, I would agree 100% with that. And the other point for me would be, well, if you break down supply chains, right, and a lot of countries in the world will need to pay a higher price for energy. And that energy, whether you believe it or not, it's still denominated and paid in dollars, right? What do you think will going to happen if the price of oil is going up? You need to buy more energy, right, at a higher price. At the same time, let's take, India, just as an example. Your currency is going down against the dollar, right? So what are you going to do at a point? Well, you will need to sell what? Your reserves, in order to get the dollars, in order to buy the energy at a higher price in dollar terms, while your currency is going down against the dollar. So you're paying more and you need to swap your local currency, which is going down. So you're suffering two dynamics, negative dynamics at the same time. So it's not surprising for me to see yields going up, expectations of higher inflation into the future, and people needing to sell the reserves. But if you sell the reserves, aka the treasuries, what's going to happen to yields? They're going to go up because there is this inverse relationship. So again, not surprising, but I'm sure there will be consequences for it, very negative consequences. The point I'm trying to make is that I don't think that all the necessary bad consequences will be on the back of the US alone, right? I think there are many different bad consequences for the rest of the world, and potentially even worse than what the US could face. For instance, I know people, especially in the US, when I talk with people living there, they're always particularly negative about that. And why not? Who wouldn't, all right? I would be negative too, sure. This looks to be the problem, right? Almost 40 trillions in debt. Okay. Now, this is kind of a breakdown on who holds what and how much of that. So as you can see, of the 39 trillions, almost half of it, it's held domestically. Now, I mean, we could argue if that's a bad thing or a good thing, right? A good chunk of that, it's held by the Fed. And again, even in here, we could keep on saying it's going to increase because we will print more money, although the Fed doesn't print money. But anyway, at least, you could say we are going to monetize the debt. All right, sure. And, you have, what was that? 9 trillions out of 40. It's kind of what? 25% roughly, mental math. Okay, so if these foreigners, they will start to dump the treasuries, as, one reason could be what we were discussing 3 minutes ago. They need to liquidate the reserves because they need the liquidity to buy something which is priced in dollars. So they will send yields spiking even higher. All right. So you may say at a point, Uncle Sam will go bust because these almost 40 trillions of debt won't be able to be refinanced, rolled over, whatever you. Okay. So is it a huge problem? Absolutely it is. I think it is. Look, the debt, when it keeps on piling on, it is always a problem. But look, if it is such a good problem for the United States, why people are not contemplating the possibility that it could be a much bigger problem for the rest of the world? Because, when you look at something like this, right, these data are coming out of the Institute of International Finance and the OECD, right? Early 2026, so relatively new, right? If you look at the overall global outstanding dollar-denominated debt, right, you're looking at a record high of 348 trillions. Okay, so look, 348 compared to 39, with a huge difference that these guys, right? I mean, even if you want to say, okay, 348 is total, but we would need to subtract the 39 trillions the US actually hold. Okay, so even if you want to round the numbers down, right? Let's say the US, it's not 39, it's actually 50. Or it will be kind of 50 in the next 5 years at this pace, right? Okay. Still, even if you assume that for the next 5 years, the rest of the world will still be kind of 6 times that. And the big difference is that at least, and again, it is not a positive, but in relative terms, at least these guys, they can print the difference. They actually have the printing press for new dollars. They are the only ones, right? While these guys right here, right? How do they acquire the dollars? Mainly by trades, right? But if there is a slowdown in economic activity and therefore a slowdown in global trade, let alone, supply chain disruptions, geopolitics, wars and whatnot, okay, and choke points like the Strait of Hormuz being closed in, right? How can they actually acquire the dollars to service the debt, which is denominated in dollars? They cannot print, but they can only acquire the trades. So who gets the lower end of the stick in this scenario right here? All right. And again, it's no mystery, right? Now that we can link this situation right here in between the debt, the yields, potential implications with what we are seeing in oil. Who hold or who gets the lower end of the stick when actually push comes to shove, right? The one which could actually print the difference, sure, at the cost of maybe inflationary pressures, all right, or the ones which can actually, do nothing. I think, all things considered, if you can actually print the difference, you're still a step ahead. I'm not saying this is a positive, but it's like, a race against the bottom where you are -2 negative, right? But the other guys are -15, -17, -20. In relative terms, you're still ahead. Or you are well equipped, way better equipped to face a crisis situation, right? And again, it's no surprise to me that while you see oil getting back up again, what you've seen is a lot of countries actually knocked at the Fed or the US administration asking for what? Swap lines. which are basically what? Dollar loans, right? And again, you may say, well, but they are just begging the US of allowing them to tap in some dollar liquidity. Okay, why would the US lend them money? Well, to prevent them to sell the treasuries, right? So I think at the end of the day, when people talk about the debt, right, and potentially yields going higher and higher, and the energy market will cause inflation to go up. Sure, it depends on the response you have to face it. So, for instance, even after what we have seen with 2020, right, inflation in the US was a huge problem with CPI at 9%. The rest of the world wasn't that impacted. Now, on one side, it's because the US actually injected a huge amount of liquidity that the rest of the world couldn't afford to inject in their domestic systems, right? And the other part is, in my view, it's just my honest opinion, right, that the rest of the world suffered a much more pronounced disinflationary or deflationary offset, in the sense that if you cannot print a difference when the stockpile of debt is mounting and you need to service that, right, what's going to happen is you're going to see defaults. People will not be able to pay the dollar denominated obligations. So they default. But if you default, that is deflationary, and deflationary is actually a contraction of the economy. So unfortunately, I'm not saying this is a good thing, but unfortunately, the way the system is designed, if you think inflation is bad, because of course it's a hidden tax or whatever, and it hits the lower bracket of the population compared to the highest bracket of the population, sure, but deflation, it's way worse. Everything goes down, right? The businesses are closed down, asset prices go down, right? Everything collapses. So in between the two, I would say, that there is a reason why a lot of central banks actually have a standard, some sort of a target that they want to hit for inflation. Because at the end of the day, inflation is a reflection, among other things, but also about growth. You cannot have growth without inflation in this system, right? So, after this tiny little parenthesis, which links in between yields, debt, and the price of oil, right? Let's have a look at the price of oil instead in isolation. Now, if you remember, when we were down here, the caveat was, sure, we can reclaim the EQ, probably at that point, can't be short oil. All right, and then what we've seen, exactly that. Last week, right, it was all up. We actually closed above the EQ. So this week, what? We basically opened above it, and we kept on going higher and higher. Now, you may say, okay, it's just, news-driven, again, because the US and Iran didn't actually come to an agreement yet. A lot of different tweets, right, about not being in line on many different things. And then we got the military actually presenting the president with new plans for potential strikes. Okay. So, the price of oil kept on going higher and higher. I think, still kind of the same up until the point we don't really make new highs. It could be, so to speak, contained, right? At least in the short term. The damage is, again, as we were discussing last week, the damages that already have been done to global economy will be manifest maybe a few months down the road. But, for now, I would keep on trading technically. Because, again, these, as stupid as it may sound, but this range is working out really perfectly, right? We just, again, take care of the range. Reclaimed, up we go. Tiny little bit of a stutter step at the range high, which ironically matches up with what this previous weekly open we got back in here. Also, some sort of an apex base, right? Tiny bit of slowdown, reaccumulation, up we go. Where to? Previous level of, there was some sort of a top in here. We basically test back into that top and we rejected from there. And again, you might say, okay, but that's because at this specific time we got that news, or at this specific time we got the other news. Sure. What about assuming it's going to behave like this, regardless of what type of news you assume you're going to have in the future, right? And now again, we close down the week bouncing off of what? Range high, which we just freshly broke out again, right? And this last pocket of accumulation, right, before the run up. So, I mean, I think oil at the very end of the day, it's trading very technically, right? If we zoom out, let's say in a daily time frame, what we see is that still going around in this range, not really moving out for now, and hopefully it doesn't. And, I wouldn't be surprised if next week we get back toward 95. Because it looks like to me, at least for now, nothing lasts forever, all right? But for now, the fair price for oil that the market actually decided tends to be 95, more or less. But I see the market always gravitates toward that price, that level. Could be 93, could be 95, could be 97, but that area right there. Okay, so, up until the point nothing changes, I would keep on running off of that assumption. Not sure the situation is slightly different if you look at the Brent, right? For all the reasons we have been discussing before, but the Brent, it's trading at a little bit of a premium compared to WTI. Don't need to go over it from scratch once again. You already know the answer at this point, right? If you don't, well, I mean, look it up yourself, right? The spread, when it comes down to WTI, it's still where it was at last week close. It was where? Around 4.9. This week, Friday closed at 5.27. So not a huge difference there on a week by week base. And again, it might be just a byproduct of the volatility that we're looking at. So at the end of the day, what do you think is going to happen with oil? We went through a few scenarios 2, maybe 3 weeks back. I think they didn't change for now, right? So, the one thing for me is that oil, it's starting to be a very crowded trade, right? Sentiment is up, the conviction that can just go up from here or there. So, if you check this one, right, it looks like a lot of fund managers are actually all in the energy trade at this point. Sure, even the semiconductors, why not, right? There's always this theme about the AI bubble and whatnot, but nonetheless, oil is one of the most crowded trade, at least, since we just ended the month of April, for the month which just ended, right? Interestingly, look at what is one of the less crowded trades. The US dollar, right? I mean, again, if you do believe that market tends to rotate in time, right? Just you kind of grasp what's going to happen. You don't know when, right? You don't know what the catalyst would be, but you kind of have a feeling for where will money flow toward when they come out of oil, right? And after that, look at the Max 7, right? They're not so crowded anymore. So again, the dollar, Max 7, it could be one huge rotation we are about to see. But again, the problem with these things is always the timing, right? All it takes, right? It's sometimes maybe even a tweet, right? I'd say someday, maybe next week, maybe next month, President Trump comes out on Truth Social saying they finalized an agreement and they're ready to sign this sort of agreement, which will grant the US what they wanted and Iran what they wanted, right? And the Strait will be open permanently. These rotation will be done in days, not in weeks, right? So again, it may be very, very violent when it's gonna come, right? And then what? I mean, even if you look at that, right? And again, we are looking at Morgan Stanley prime brokerage, right? And this is basically the hedge fund energy net exposure compared to the Russell 3000. So, you can do the math on that, but you see it's basically very, very high at this point. So there is a huge imbalance toward energy for now. Now, again, just because a situation or a trade is crowded or is one-sided, whatever you want to define it, doesn't mean that it's going to be reverted or erased or obliterated next week. It just means that the risk is mounting and mounting, right? It's like whatever, it's like a bubble. You can stay in a bubble for months sometimes before it actually pops. I'm just saying that, somehow the risk reward is actually skewing against you at a point. At least, if you assess things from a positioning standpoint, right? Then, of course, if you try to throw at it all the fundamentals, all the potential implications for geopolitics, war developments, and whatnot, sure, it may keep on going for another 2 or 3 months. Who knows? I'm just saying, if you just look at the positioning, it starts to be scary a little bit. It's just, you wouldn't buy oil at these prices, right? I mean, you wouldn't go long. Maybe you want to be long in here or in here, but in here, considering what we are looking at in the positioning and the sentiment and all these doomsday scenarios where oil should be at 140 and, the global economy will be broken apart. Sure. Look, the market for now is begging to differ. Could the market be wrong? Absolutely. But it's pointless to fight it, all right? So, when instead you check, see if I have it. I should, I think. Yeah. When you look at the forward curve, what I mean by that is this essentially. So you got the spot price, right? And then you have, let's say, your year-end type of price for the future contracts, which is now around 80. Right? So again, the market could be wrong. That doesn't mean that this is, a done deal. It's not written in stone, obviously, but this is what the market is telling you for now. They are expecting from here to year end, or basically December, oil will be trading back into the 80s. Will it happen? Maybe, maybe not. This is just the market expectation. It's still a valuable data point because, expectations could then be met or disappointed. So again, still something you should keep in the back of your mind, right? And again, if we zoom out on a daily time frame, right, and we look at this chart going up, although, it would have made much more sense to put them on the same chart. Can we do that? I think we can, just for the sake of it, right? So that we can have some sort of a apple to apple, so to speak, comparison. So it should be CLZ. Should be in here somewhere. There you go. December. There you go. So, this is it basically. the spot price or the upfront contract went up, sure, 49%. Let's have a look at this. Year to date, right? Year to date is actually up 78%. And instead, same time span, the price that the market is considering fair for December, so year end, is up, sure, but 39%. Which, if I'm not mistaken, it's kind of half of it. So again, will B energy stay up or higher for longer? The market is telling you yes, but to what degree? Not this one, right? So still the market is pricing in a relatively, quick enough resolution of whatever crisis or conflict caused this spike in oil prices, right? And then we have all the discussions about, demand destruction and whatnot. Another thing which could add fuel to these, quote unquote collapse of oil prices, right? I don't know if you noticed that, but looks like the UAE, so the United Arab Emirates, they are trying to quit OPEC. Now you might say, okay, but so who cares? I think you should care to some degree because look, if you think about what OPEC is, OPEC is basically a cartel, right? It's nothing more than that. The problem with a cartel, in my view, is that you cannot do what you would like to do or what is in your best interest 100%. Now, what was the purpose of the cartel? Well, to keep production at a level which, when you compare it with, current demand, will allow the price of oil to be high enough to grant all these producers in the OPEC and OPEC Plus good revenues. All right. So now, why would you think the UAE would express this desire to leave? I think, and again, maybe just my speculation, I think that they have seen what happened, especially when we were here in 2023, 24, right? After the Russian invasion of Ukraine, back in the days, right? So to speak, all this period, 23, 24, and all the rest, right? They have seen what happened there when, if you remember, oil was just going down and down and down, right? And what were they doing? They were cutting production. They were cutting production while the market was going down because they thought they could have prompted the market higher. The thing is that although they were cutting production, global demand was falling at a much higher pace or faster pace. So not only they were selling oil at a lower and lower price, but since they were cutting production, they were selling less and less volumes. So they were losing on both sides. Because at least, if oil is going down, but you are selling more volumes, you are making up for the fact that you are selling at a lower price. But if you are getting the worst of both worlds, it's not something which actually helps you out over the long run, okay? So now you see them, on one hand, going to the Fed, asking for a swap line for US dollars. On the other hand, they decide to leave the cartel. And by recent estimates, the cartel basically for now, it's kind of forces all these guys to just sell in the market 80% of what it could be their potential capacity of production, right? So imagine that. Let's say you could produce 100 barrels a day, but OPEC tells you that you can only sell in the market 80 of them. And the remaining 20, you shouldn't, right? You need to, to storage them, to keep them out of the market, all right? But, if I have to respect these quotas, I'm actually losing money. And who tells me that all the other guys around me are actually respecting them? Because, again, on top of that, they are very suspicious in between each other. So the bottom line is, if they get out, the war actually ends, the strait opens back up, they start, instead of throwing at the market 80% of their potential production, 100% of that. The US are already, sending out oil at the max of their capacity. Russia probably doing the same, right? And what do you think? I think the answer at a point will be oversupply of oil. Therefore, a collapse in price. Now, again, it's one of those theses, whereas, kind of like the rotations in markets, you don't know when, right? But there will be a catalyst. Now, for this one, the catalyst is basically obvious. It would be the resolution of the conflict and potentially the reopening of the Strait of Hormuz, which again, it's not that you sign a deal, you say it's open back up, and things collapses the day after. And you would need a bit of time to these supply chains to get back in balance. But actions have already been taken, right, to reroute oil flows. So I wouldn't be surprised again. Might be from here to December, it might be in 2026, sure, but I would think at a point you will see oil prices getting back down, right? I have very hard times, right, to see oil trading and then sustained above 120, 130. Can this happen? Sure, anything can happen. I just don't see it sustainable, right? So, that would be it for me when it comes down to oil yields and all the talks about the debt, inflation. It is a long topic, but it is fascinating to some degree, which is why sometimes I spend a bit of time talking about it, right? Now, again, let's have a look at stocks and then wrapping up things here. So again, the stock market this week was kind of a two-tape market, especially initially throughout the week. The week opened up in here on Monday. So, kind of choppy. Tuesday, we went down, but really unable to break to new lows. A lot of choppiness throughout Wednesday. And then, Thursday, a little bit of the same, but, on a much larger range. And then, Friday was a up-only day where, I think the differentiation here was that the Nasdaq was able to retain a lot of the work to the upside, which was made throughout the day, okay, while the S&P didn't. Now, it could also be, let alone the Russell, it could also be that on Friday, where, again, I repeat, I was out, so wasn't really following in real time, but there was around, I think it was midday, because I got a notification at 5:30 here, so kind of midday Eastern time, I guess. Trump, out of nowhere, coming back talking about tariffs. And I think he was talking about auto, so cars tariffs, back up to 25% against the European Union. I honestly don't know why. Maybe because there should be some sort of they agreed on, a framework before, but then the European Union is refusing to ratify it because in the meantime, the Supreme Court judged the previous tariffs are unconstitutional or illegal. So, the Europeans are kind of like, why should we ratify something that you imposed and your own local Supreme Court is telling you that you couldn't? So, there is a little bit of a stall, I guess, and Trump, as usual, being Trump, just moved ahead by, showing strength, right? Showing the muscles. Will it be different next week? I don't know. We have seen these tariffs being announced and then the tacos and all the rest, but, this is how the market traded this week. Now, when you look, zooming out, what you see is that there is a little bit of a divergence. Look, now, if you check, for instance, the Dow and S&P futures, the Dow actually had the weakest close on a Friday, all right? Although, you could also argue that throughout the rest of the week, they both pushed at or toward new highs, all right? The S&P, so in this case, ES futures, they closed the week with these tiny, how do you call it? I mean, people may call it what? A shooting star, a pin bar. You know, it looks like rejection, right? Because, we went up, there is a huge tail to the upside, and we actually closed below the open for the day. Although, if you look, for instance, at the other two, like the Russell, it closed relatively, in line. On a closing base, it was a new high in here. It closed relatively near the recent all-time highs. And the NASDAQ futures actually went up. And, look at the difference in between, the candle printed on a Friday, both in the NASDAQ and in the ES mini futures. There is way less tail or shadow to the upside here, and a hell of a lot more of a body. And of course, the close is above the open for the day. So a little bit of divergence building up in here, which again, it's not surprising. Do you remember how long did I spend saying a real bull market for me would be where the NASDAQ is actually leading? Because I think the most growth, it is actually in technology. All right. So it looks like we are seeing it right now. Look, does it mean that, if you judge on the S&P, you should say, yeah, this is it. Are we topping out? But then you look at the NASDAQ. Well, actually, we're not. And, at the end of the day, technology is still kind of like what? 35% of the weighted index. So I'm just saying, to me, it would be strange to top out on the benchmark if, the sector which is representing 35% of it is still pushing to the upside. At the very least, let's say, I might say, okay, so the market is getting particularly concentrated. The other 9-10 sectors are actually struggling a lot, if not pulling back. But, if technology is still going up, at the very least, maybe I'm imagining the index and saying, you know what, maybe the benchmark, the S&P 500, would just go sideways a little bit. So, up until the point technology can actually hang in there and keep on pushing higher and showing strength, right? Now, if you look at this different layout in here, again, the pin bar, whatever does it look like exhaustion on SPY here? Maybe, but again, look at the moving averages. The momentum is still present in the market. We are still trading above the very short-term moving average in here, right? We still have a decent delta in between the blue and the yellow. And, again, they're all upward sloped. The delta is increasing, in between the yellow and the blue, the yellow and the green. We are above essentially the 200, the 100 days moving average, the 50 days moving average. So, I mean, it's hard to be bearish, right? And again, should you fight this tape? I don't know, I wouldn't. Now, sure, if you really zoom in, okay, and you start to think, oh, well, look, we made new highs on a closing base on SPY, but the RSI didn't make new highs. So are we building up a little bit of divergence? Sure, maybe. If you look at the stochastic, it's overbought, sure. The MACD, as we were noticing last week, it's starting to lose a bit of momentum, especially if you look at the histogram. Okay, but I mean, again, the market can stay overbought quite a long time before actually giving in. So I'm sorry, but I cannot fathom a top being put in. Again, am I blind? Maybe. I'm not discarding the fact that the breadth is actually decreasing or deteriorating, but at the end of the day, I trade what I see and I trade the market. So up until the point I don't see it, I can't trade with conviction to the downside. I don't call tops, but I trade them after the fact. So, now trading it and let's say managing a portfolio are two different things to some degree, because if you approach these from the standpoint of, well, I had a bunch of stocks which performed relatively well in this period, right, with this huge run up. So maybe I don't want to short the market before a top is actually in, but should I trim a few of my biggest winner? I mean, if I got stocks in my portfolio which went up maybe 30, 40% in these, V-shaped recovery, should at least trim them and getting back them down to target weight? I guess in this case, absolutely yes. Sure. Why not? So, it depends on how you approach it, I think, right? But there is a difference in taking profits, right? And calling a top and trading as you would expect a top to be already in, right? So again, I just let the market to tell me what I should do. I don't try to fight the tape, but I try to trade with the tape rather than against it. And I think over the long run, the odds of you being successful are much higher if you trade with the market rather than against the market, right? Now let's have a look instead at, again, we're talking about breadth, sure. So this is basically the index, and in black in here, what you see is basically the RSP, so the equal weighted index, all right? Okay, so you may say, okay, so the index went up, and the drag to the upside, the draw to the upside, was mainly the heavy lifting was made by technology, and especially, I don't know if you checked, but SOX, right? Semiconductors, okay. But, if you just look at the RSP, didn't even make new highs in this V shape. So again, we are looking at a divergence in between the market cap weighted index and the equal weighted index. In the past, sure, it may signal a bit of underlying strength of the market being diminished, right? Sure. But I should also tell, it's not always a good timer for where and when a top or a short-term top, a pullback, a retracement, whatever, it is actually initiating. So take it as it is. I think there is nothing wrong in taking profits, but, going all in cash, opening up shorts, maybe I would wait for it, okay? Other than that, the story for the week, of course, we were talking about earnings. If you look at the weekly performances for, Meta, down, Google, up, decently up, more than decently. Microsoft is slightly down for the week. And then we got another one, which I don't remember now. I think it was, there were three of them. Google, Meta, I can't remember the fourth. But you know what? That's not a huge problem because I have screenshots. So let's have a look at these on the topic of earnings, right? It was Amazon. All right. So, I mean, we can look at what the earnings were, the results, but again, we were looking at guidance being a particular crucial factor for the market this time around, because at the end of the day, they kind of all, showed up good earnings, right? But, a few of them showed a bit of weakness that maybe the others didn't. So in this case, you just read the paragraphs, right? I don't want to read it all, but, this is kind of the current situation. The thing is, for me, I think, we are at that point where the market, it's buying the future, right? The AI build up, but the market just wants to see a bit of results now, okay? So, for instance, if you look at that, there is a difference in how, let's say, Google, right, performed, and what type of things the market actually looked into, right? So, for instance, Google, if you don't know, they got, when it comes down to cloud service, right? they have their own. Amazon, for instance, they have AWS, so they got their own. Microsoft, they got Azure, so they got their own. Meta, they don't really have anything proprietary, right? So I think the market is trying to look into it and trying to sniff a few differences here and there, which would lead to, a relatively strength of weakness in between one stock and the other. And at the end of the day, after you have read all the paragraphs, right, you can see that, sure, we are still looking at capex going up and expanding and whatnot, but the market is putting under scrutiny the real, odds of potential returns when it comes down to revenues by these companies, which are all in the same sector, are all trying to build up the same thing, different ways, most likely, but they're all working toward that same goal. And the market is just trying to assess, in my view, which one of these actually has the best cards to, maybe win the race, right? And when you look at what they did, Google, well, the market treated it well. Microsoft, well, not so well, but it wasn't a complete collapse, right? While instead Meta, it gapped down and it stayed down even on Friday. So, I guess the market is picking winners and losers, at least for what concerns these earnings season right here. So Q1, right? And then what? Amazon, which was kind of neutral at the end of the day. It jumped on earnings, then came all the way back down, but then it managed to close near the recent highs. So, kind of neutral for me, right? So that could be it when it comes down to the earnings that we have just seen. Other than that, we are still looking at these midterm pattern. So, we should expect, at least throughout the month, we just wrapped up May, right? So, April. So going into May, June, don't be surprised if we see a bit of weakness. In this graph right here, we're just looking at what is the usual seasonal pattern in normal years compared to midterm years, right? So, a summer which could be a bit weaker than usual, as we were discussing last week. Potentially, yeah, it's in the cards, so don't be surprised. Don't panic out if you see the market being a bit weaker. But I would also say, probably, although the good old adage selling may go away, I think at the end of the day, the months where you may see the potentially, right? We don't know yet, but potentially, if there will be some sort of a correction, the months where it may be more severe could be actually August and September, right? Rather than May, June, right? Because, actually July tends to be a good month historically. So who knows, right? And then after that, a little bit of a look, still a few seasonal data. Now, what we got was one of the best April ever when it comes down to returns. Why not? The huge V-shaped recovery. Okay. Then look, usually good April results tend to lead to, good returns into the future, right? So, whenever April is very good, what you see is that even May is not that bad, right? And, if you look at the rest of the year, more often than not, it's particularly positive. So just, in order to assess the potential volatility we may have intra-week, but remember that historically, these are the stats for the mid to long term, so to speak, right? Then what else? Yeah, exactly. You see that? That's another representation. If you expect a downturn, so to speak, I'm not talking 20, 30% pullbacks, but just, maybe another 7, 8, 10% pullback. I would expect the odds of that manifesting itself to be much more acute in August or September, right? Because again, July tends to be an okayish month, right, compared to all the rest. Believe it or not, but these are data getting back to the 50s. So, it's not something you should discard. Again, still, it looks like, again, we are getting into a period where on a 6-month base shouldn't be the best of the year. But again, there are a few months, even in that period, which is not good or that good overall. There are a few months like July, which could, have surprises to the upside for us, right? So don't be overly bearish at the very end of the day. Now, these are the actual monthly returns for the S&P from 1964 up to 2024. So not really including 2025, but just for a frame of reference, you can check them here, right? They are still kind of telling you the same story, right? And again, look, April, it's kind of one of the best months. May, June, not so good, but really, if you are looking for some scare, August, September may be your best bet. Then what? Look, throughout these correction that we got in here, right? So throughout the month of February, March, right? We got what is defined as valuation compressions, right? So you think about all your metrics, your PE, your forward PE, and all the rest. We had a compression, right? Okay. So look what happened usually after valuation compression. A good period tends to follow, right? It's kind of like, you could think about it as when you see the market going up and you look at some indicator. It could be your stochastic, your RSI, your MACD. The market is overbought. And then you have maybe a consolidation, the market going sideways, correcting through time, or maybe a pullback, so an actual correction of the market. The overbought condition goes away, and then we are ready to buy back into the market because it's not overbought anymore. You could think about valuation compression the same, right? They get particularly exuberant, they get back to a much more acceptable level, and then, they go up once again. So, it could be something like it. And at the end of the day, still, what moves the market is these earnings, right? Curiously enough, usually what you have observed over the last 15 years is that earnings, especially, projections and whatnot, they're always particularly high at the beginning of the year, and they tended to be revised lower while we go through the year, right? Since 2011 to 2025. This year, they're actually continuously revising them higher. And again, when we talk about estimates, when we talk about projections, is that a crystal ball? No. But again, if the market is a discounting mechanism, it will trade on expectations, right? The market is not pricing in yesterday or today. The market is always trying to price in next week, next month, next quarter. And it's just millions and millions of people. It's an aggregate of knowledge, right? So, can it be wrong at times? Yeah. And when it is, it will reprise for a new reality which unfolded itself. But, up until the point it doesn't happen, this is what the market will be, trading off of, right? And, again, they updated this chart once again, and it looks like, again, they are ratcheting higher whatever potential APS or revenues projections. It looks like there is a huge conviction that, everything will work perfectly. I think, to some degree, you could also say the market is priced to perfection. Is it a good thing, a bad thing? Well, again, it means it will keep on going higher, but at the same time, it just takes a smaller and smaller and smaller disappointment to completely reverse it, right? It is priced for perfection, so a tiny degree of deviation from perfection may impact the market more than what you would expect, right? That's just the thing. sure, it increases the fact that it's going up, but it also increases, the response to the tiniest disappointment you may think of. And you might wonder, why the market dropped 2%, 3% in a week on this headline? Well, sure, I mean, maybe it wasn't the, catastrophic headline you could think, but if the market is priced for perfection, if it is not perfect anymore, it's going to respond to some, larger degree, right? That's the bottom line of it. And finally, a little bit of a positioning. I mean, again, it looks like positioning screaming higher for now. Now, this one in particular is systematic positioning, right? Not discretionary. But again, this is another one of those themes by which we say don't fade the tape, don't fight the tape, right? The thing with systematic positioning and systematic, strategies like CTAs and whatnot, look, these are mainly momentum type of strategy and algorithms. So up until the point the market doesn't break the momentum, they will be buyer, right? They will shift as soon as the market breaks the momentum, right? So it looks to me like the momentum is not broken yet. Therefore, again, I can't really be bearish this market for now. And I think you shouldn't either. We may have a bit of volatile days here and there, sure. We had that, right? We had that over the past 2 weeks. I think the market, especially intraday, was volatile enough, right? But at the end of the day, we're still grinding to the upside. Okay, so I wouldn't stand in front of that, right? Now with that, this is pretty much it. Next week, I think we're gonna have what? Not a lot. ISM services, PMI, and then what else? NFP, I guess. I think it's NFP day, a week. Yeah, there you go. Expectations for this one? Well, considering the ADP reports we've seen so far, I wouldn't. Previous was a banger, 178. The forecast is 95, consensus 73. Look, I wouldn't be surprised if it comes in above 100 once again. It's just gut feeling, right? Don't have any type of hard data to confirm it, but just looking at the trajectories of other data for the labor market and considering all the quirks, the seasonal adjustments, I wouldn't be surprised if it comes above 100K. So probably another huge beat. But again, we'll see it when we have it, right? So for now, trade the market you have, not the market you think it will be. And other than that, try to stay out of trouble, so to speak. So I'm going to leave you off with that. Wishing you a very good rest of your weekend. And as usual, be nice and be cool. Nils out.
Mm-hmm. 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 Come on. Mm-hmm.